For the LIFO me, I can't understand why people don't love the inventory chapter in our accounting textbook. Welcome to Accounting How To. I'm your host, Carolyn Grimm. That's my sidekick, Terrence. And we're here to put the fun in accounting fundamentals. And remember, I don't charge extra for the accounting humor. In this episode, we are continuing our inventory exploration with another example ripped directly from the accounting textbooks of the world, where we are going to go through LIFO as an inventory costing method. LIFO stands for last in, first out. So we're going to sell whatever we got off the truck today first and forget about everything that we had in inventory previously until we get around to selling it. So let's jump directly into our spreadsheet where we are going to go through the same transactions that we did for FIFO. Now we're going to do it for LIFO. So these are the exact same transactions that we did for FIFO. And of course, if you haven't seen the FIFO video, it's in the description. So it is there for you to watch when you're ready for it. So here are the transactions that we're dealing with. We have our date, we've got our transaction type, we've got the number of units, the cost when we know it, and the inventory amount when we know it. So just like with our FIFO example, we start out with a beginning inventory of 120 units, and the cost is $26. So our inventory is $3,120. And we have entered that in our T account here over on the journal entry side. Here's our $3,120. This is what we're starting out with. Now, the first thing that happens is that on June 10th, we have a sale, and we are going to sell 90 units. So the only units that we have in inventory are these 120 units at $26. So we know that the cost of merchandise for those units has to be $26 because that's all that we have. So we're going to sell 90 of those at $26 for a total cost of merchandise sold of $2,340. That's going to leave us with 120 minus 90 units for 30 units at $26, which will give us an ending inventory at that point of $780. So let's jump into the journal entry. This is going to be the exact same journal entries. The only thing that will change will be the amount that we cost our inventory at as we move through these different transactions. Here we are with our journal entry for 6/10. We are recording our sale to our customer. And again, we're assuming that it is a $50 sale price to our customer. So here's our accounts receivable for $4,500 and our sales for $4,500. So now we have recorded what our customer owes us, and we've recorded our revenue for this sale. The costs that we're going to apply to this, because of the matching principle, we want to get our costs in the same month with the sale that they go with. So we're going to put a cost in here of $2,340. We're going to increase our cost of merchandise sold, and we're going to decrease our inventory. In our T account, here's our beginning inventory of $3,120. Here is our reduction of inventory for $2,340. And of course, we would be recording all four pieces of this journal entry in our accounts, but for the purposes of this, I just want to track the inventory account through this process. So we've reduced our inventory by $2,340. Gives us a balance of $780 when we take our beginning inventory minus our reduction in inventory, gives us our ending inventory balance at this moment in time. And that ties out to our funky inventory spreadsheet. Then what happens? On June 15th, we purchased 140 items, and that cost was $28. So the cost has gone up. We want to keep our inventory sheet completely organized. So we're going to bring down our oldest inventory, and then we're going to add on our newest inventory. So here's our 30 at 26 for $780. that are left over from the previous transaction. And here are our 140 units that we purchased for $28, and that is $3,920. What's our journal entry in this case? It's the exact same thing as it was under FIFO, because all we're doing here is we are recording what we actually paid for this inventory. So $3,920, we're increasing our inventory account, and we're increasing the liability accounts payable because we need to pay for this later on. So in our inventory account, when we go post this on our little T account, and again, post everything to all your accounts, but in this case, we're only looking at inventory. We started with 3,120, we sold 2,340, and now we're adding on 3,920, which gives us an inventory balance in this account of 4,700, which is these two items, 780 and 3,920 added together. And here's a little check figure for you. Now what happens? We're going to sell some of this inventory. Now this is last in, first out. So whatever our newest inventory is, the last ones that we bought, that's what we're going to sell first. So last in, first out. So when we go to record this sale, we want to go to our last items that we purchased. So if you look right here where it says 0 of 26, we are selling none of these items here that were left in inventory. This 30 at 26, we're selling none of those. So we're selling 0 at 26. We are taking the most recent things that we received, the items that we purchased, we're taking it from here. So we're taking it from the 140 that we bought at 28 rather than from the older stuff, the 30 at 26. So all of that is coming from our last items purchased. So 110 units of those 140 units we are now selling. So our cost is going to be 110 times $28 to give us $3,080. When we bring down our inventory now, we're still going to have 30 items at $26. We have not sold those. And we've now sold 110 of the 140 that we bought at 28. So we've got 30 at 26 and we have 30 at 28. When we jump over to the journal entry side of things, again, assuming that we're selling this to our customer for $50, we've got accounts receivable for $5,500, and we've got sales for $5,500. And then our cost of merchandise sold is going to be this total cost number in the cost of merchandise sold column. So $3,080. So we are recording this expense to match it up with our revenue, and we are reducing our inventory by $3,080. When we pop that into our T account, here's our reduction. And we now have a balance in our inventory of $1,620. If we jump back over here to our funky spreadsheet, that $1,620 is made up of 30 at 26 and 30 at 28. And here's our check figure to help us know we are on the right track. And then on June 24th, we're going to sell 40 more units. So we are going to sell the newest items first. We have 30 of those units left. So we're taking that right from here, our last items that we purchased. So we're going to sell 30 items at 28, and then we're going to go back into the older inventory and we're going to sell 10 of those to make a total of 40 at $26. So now we've used up all of our $28 merchandise, and we've used up 10 of our older merchandise. So we have left in our inventory 20 at 26 for $520. When we jump over to our journal entries, accounts receivable, we're increasing that by $2,000 to represent that 40 items at $50 that we sold our customer. Here's our revenue at $2,000. And now we're recording our cost of merchandise sold based on last in, first out is $1,120, which is these two guys right here added together, the $260 and the $840. When we pop that into our T account as a credit, we now have a balance in our T account of $520, which ties out to our inventory spreadsheet. Let's look at our final transaction. So we purchase 160 items at $30. So now, again, because we've kept things organized, now we know that we have 20 at 26 from our older merchandise. We're bringing that down, keeping track of it, and we now have 160 at 30 that we're adding on to our inventory. And here is our journal entry that goes along with that. We're increasing our inventory at 4,800, and we are increasing our accounts payable at 4,800. When we add that debit to our T account, we end up with a new balance in inventory of 5,320, which is 20 at 26 plus 160 at 30 for 5,320. Now our next transaction, our next sale transaction under LIFO, we will be pulling from that 160 at $30 a piece. One of the things that your textbook may ask you for is they'll give you this information here, and then they'll ask you what the cost of merchandise sold was for the month. And the way that we get that is to simply add up those different transactions right there, and that will give us the number. Now, if we had been tracking all of our T accounts as a proper accountant would, we would have been entering those transactions in a T account, and then we would have that balance available to us. And you absolutely can do that. Now, something else that your textbook may ask of you is to determine what the gross profit or the profit is on sales for that month. So how do we figure that out? We're going to take all of our sales transactions, and here we've got 4,500, we've got 5,500, and we've got 2,000. So we're going to add up our sales, and we're going to subtract from that our cost of merchandise sold, and that's going to give us our gross profit. So there you have it, LIFO, last in, first out. In the next video, we will go through average cost. So until next time, stay balanced, my friends.